All right. It looks like it's about that time. So thanks again, everybody, for joining us on the HST Tax Advisory Group webinar. We're going to go over proactive planning for business owners, how we help them save taxes. We've got James Hens here. He's been in the business for over 40 years, helping business owners save significant taxes. And he's going to walk us through some of the strategies that they use at HST. Like I said earlier, if you have any questions, feel free to enter them into the chat. And with that said, I'm going to let James go ahead and take it off for us, and we'll go from there.
Great, thanks, Jordan. Welcome, everybody. Just to give you a little background, HST Tax Advisory Group is a firm that has been, in my mind, forming for a number of years. Everything we're going to talk about today, we can do nationally. We do tax work from coast to coast. So everything that will be contained in this discussion will be applicable no matter where you are located. In addition to that, everything we are going to talk about is 100% legal. Everything we look at is taking advantage of tax avoidance techniques, not tax evasion. Tax evasion is illegal. And we do not promote, nor will we get involved in anything that would be anywhere considered even a gray area. It's black and white, everything we're going to discuss with you. So getting started, who we are, again, we're a Houston-based firm, and we provide proactive tax planning services with the end goal of minimizing federal income tax, matched with state-of-the-art compliance services. Again, our core competencies are mitigating federal income tax. We do provide bookkeeping and financial statement preparation that some clients take advantage of. Some clients, business owners, do their own, but we are there to provide those services. We also provide income tax filing, sales tax filing compliance, ultimate minimum tax planning, and multi-state tax compliance. So again, regardless of where you come from in the United States, we understand the states and the federal tax rules that are applicable, not only on an individual basis, but as a business, on a business level as well. And we do get involved in international tax situations where needed. The agenda today, we're going to look at is tax planning versus preparation, key tax saving drivers, the tax planning process, some real life examples, a value proposition that we all share with you, and then we're going to get into some Q&A for those individuals that have questions. So tax planning versus tax preparation. You know, I've been doing this for almost 40 years, as Jordan mentioned, and it just blows me away that most accountants and CPAs primarily focus on tax compliance and preparation versus tax planning. And typically, they're kind of looking at this in reverse. And I categorize a lot of these guys and gals being historians. They're always looking over their shoulder. In contrast, if you really want to reduce your tax liability, you need to look at tax planning, looking at a person's life, business, and regulatory requirements that legally can reduce their taxes, using multiple strategies along with entity planning that can result in significant tax savings if done properly. Tax planning does require the understanding of the requirements and the tax payments, but also and return preparation, but also it's the knowledge of business accounting and corporate structures in tandem to planning to reduce your obligations from a federal and state tax standpoint to its lowest common denominator. Tax advisory is a unique to each individual and business. Some strategies will work for you while others will not. So we're looking at different strategies, and we run into different situations. It's a broad spectrum. It's not a cookie cutter. One strategy or product will work for everybody. And we understand which ones are right for most businesses. Income tax planning must be a year-round activity. it must begin early in the tax year. Once it's time to file your tax returns, it's too late. Planning is over. You've already missed the opportunities that will help reduce the federal income tax that you're ultimately going to pay. It's got to start in January, not in December. So what we try to do is get our clients to do proactive planning throughout the course of the year. And this is some of the differences. The key tax saving drivers that are most critical to drive tax efficiency begins if you're a business owner in entity planning, cash flow planning, business deduction maximization, accurate, up-to-date books and records. And I can't say this enough. A lot of businesses, and that includes medical practices to manufacturers to real estate to oil and gas, whatever the type of business is, one of the biggest issues we run into a lot of time are the books and records aren't up to date. And typically they're getting their financial statements on towards the end of the year. There's no way we can look from a planning perspective. We can't look at what your current finances are to make those recommendations and so forth. And this is one of the easiest ones to fix. Then when we get into the individual deduction maximization is also critical, but we look at all this on a holistic standpoint. Entity planning is critical. Did you know that the type of entity your business can have a significant impact on your taxes? And depending on what type of business you have, most people don't understand what they have. And when we ask them, what is your tax structure? The most common question we ask or response we get back, well, I'm an LLC or I'm a PLLC if I'm a doctor or a dentist or lawyer. These are corporate structures. They're not tax structures, because an LLC or a PLLC, it can be taxed as a C corporation. It can be taxed as an S corporation. It can be taxed as a partnership. It can be disregarded entirely for taxes. And they're all different from a savings strategy, depending on what type of business you are, where you are in your income and net income on an annual basis. So there's a lot of thought that needs to be brought in. And the wrong entity structure can cost you tens to hundreds of thousands of dollars in tax savings or additional taxes on an annual basis. So it's critical in the planning. And in many cases, most business owners don't understand that we can use multiple entity structures in one business to take advantage of different strategies that with the ultimate goal of reducing your maximum tax that you have to pay not only at a federal level, but as a state level as well. I'm going to give you an example, and I'm going to use a large number because it shows what the significance of what I'm talking about. Assume you purchase a building for your business for $1 million with a $600,000 loan attached. Now, most business owners that I deal with don't have a lot of cash laying around, so they have to use financing to acquire their business assets. And that doesn't necessarily have to be a building. It could be a very expensive piece of equipment, what have you, but they use financing to acquire it. Structured improperly, assuming a $600,000 loan, that when you go to amortize that principal back, pay the bank back or the finance company, if done improperly, it could cost you as much as $252,000 more in tax than if properly structured. And what I mean by that is, in order to amortize debt, you have to earn it to pay it, because the amortization of principal in a business setting is not deductible. Only the interest is. Now, you may get to depreciate that building or that asset that you acquired for that business, but when you pay that bank back, you have to earn it to pay it. So if it's in the wrong type of entity or it's held personally, you're paying more to amortize that bank than you have to. And to give you an example, if you structured this properly, the building finance costs at $600,000, if you have to earn it, could cost you as little as 762,000 versus 1,014,000, that's a $252,000 swing in cost. This is not funny money, it's real money. And I see business owners make this mistake day in and day out, where their accountants have them hold the note personally, or it's held in the wrong type of entity. And that amortization of that principal can ultimately cost them significant more in taxes, because you pay tax to earn it, meaning you have to earn it, pay your income tax, have a dollar left over to amortize that principal. Doing this the right way, it can save you significant amounts of money down the road. And to determine which best requires analysis. Most accountants aren't doing this. And when we explain this to an accountant or the banks are more than happy to restructure that debt, because if we can put our clients in a better tax structure, we make them stronger as a borrower. The banks love this, and we can share with this actual examples with you if you give us the opportunity to share some knowledge with you. Again, this is where we come in. HST takes this type of structure and shares that technology with you to show you where you're spending too much money, and we don't know that until we do the analysis.
So it's almost like saying you can pay your debts back with 75 cents on the dollar, right?
Approximately, assuming you're at a 40% tax bracket, you can save 27% of that. So it's 42 cents for every dollar that you're spending. We can really make an impact. And the next component to this, from an entity planning standpoint, and this is where from a business standpoint, cash flow is everything. And so along with entity planning, cash flow analysis can significantly reduce your tax liabilities by timing the taxation of income in the proper entity and the proper tax period. Shifting the income back and forth depending on what kind of year the business is having in a different tax period, in a different entity with a lower tax rate, can significantly bring that ultimate tax liability back down to the lowest common denominator and give you more money and build more wealth for you over time. Timing is essential in overall planning. And this goes back to the bookkeeping, making sure your financial statements are up to date on an ongoing basis so you can track this to make sure that you're paying the minimum amount of tax that you have to. Business deduction maximization is all part of the process as well. Taking every business deduction available may sound straightforward, but it's not. Certain deductions are available for certain businesses, but they're not available for other types of businesses. Difference between S corps, partnerships, and C corps, even disregarded entities, they are not all treated the same from a tax standpoint. And depending on when you start your business, you may graduate from a sole proprietor to maybe an S corp, to maybe an S corp and a C corp, or to a C corp or a partnership, depending on how many partners. There's a lot that goes into this, but to maximize those deductions, you got to match them to the right type of entity and what you're ultimately trying to achieve from a business standpoint. And then making sure that this is looked at on an annual basis as the ever-changing tax rates change, tax policies change, whichever is coming out of Washington. You got to make sure you try to anticipate some of this so that you can place those potential deductions in the right type of categories so that you can take advantage of them as they come along. Again, we've covered this a couple times. I beat this to death, but accurate up-to-date books of records is a critical component, making sure that we have enough information on an ongoing basis to find out where you are, so you do that planning going forward to reduce those tax obligations going into the future, instead of waiting to the end of the year and try to figure it out by doing your financial statements at the end of the year. It's too late, and doing it up front is going to save you a lot of income tax and gives you more opportunities to grow. Individual tax maximization typically comes at the through the course of the year as well. But once we get the business structured, we got everything on, and then it determines what you need to live on. we have a big, one of our mantras that we live by in this office, and we try to share with our clients. You should pay your highest marginal tax rate on the amount of income you're consuming, not what you're earning. So just think about that. Whatever I need to spend that maintains my lifestyle, it's not a budget, whatever maintains your lifestyle, that should be your highest marginal rate. And whatever you don't need to live on, if you're in a business, you should have a lower tax rate. And if done properly, we can keep whatever you're not spending to maintain your lifestyle and reduce that tax obligation. It's going to do two things for sure. It's going to increase your opportunity cost, taking the taxes you were giving the federal government to either grow your business or build more wealth for you. It's that simple. And it takes, again, that planning, accurate books and records, forward looking instead of looking in on a historical basis. We try to get our clients to stop looking over their shoulder and start looking forward. This is where our advanced tax planning analysis comes in. We provide strategic entity planning. We provide business and personal cash flow analysis. We do deduction planning and optimization for business and personal tax situations. We do this with some very sophisticated tax software. And I'm going to tell you this, if I had this software 40 years ago, I'd have been retired a long time ago. It's got to the extent where we can do planning now that will actually read tax returns, and we can do a historical basis, what you did last year. We can look at what the current year is, and then we can layer on what's coming up, potentially coming out of the Biden administration with some tax policies, and do some what-if scenarios. If the tax rates change to here, or what we expect them to be, what is the impact, not only on an individual basis, but on a business basis? We have this software that actually can calculate and put strategy in there to show you in numerical terms what the impact is up front, so you can kind of get an estimate, if we do this planning, what the impact will be. And I'm going to go through an actual proposal with you. This was an actual business client. This one was actually a medical doctor, I believe, and we did entity planning with this individual on a multiple entity standpoint. And we don't have time on this call to go into the actual strategy, but I'm going to run the analysis that the software is looking at. We're doing planning versus preparation. We're going to look at estimated tax savings, what you lost last year based on if we would have had this strategy in place. It categorizes tax planning strategies, stages of planning, and it goes through the whole process. And this is a software application that we provide our clients that we run on an annual basis for the clients and new clients coming in to see what the impact would be with some of these strategies that we're going to talk about. In this case, the estimated savings came in 2020. This individual came in 2021. We would have saved her $53,514 in actual federal income tax. In 2021, we actually saved her more than this, but based on what our projections were, we're going to save her $61,850. It actually come out to be over $70,000 we saved her versus what it would have been. And in 2022, where we're looking at about 65, and it looks like it's going to be about 70,000, depending on what comes out of Biden administration. There's some of the tax policies that we're seeing. We think federal income tax rates are going to accelerate. It's going to be hard based on the economy. It may not get in next year. It may get derailed a little bit. But with all the stimulus going out, if you don't think the federal government is going to increase tax rates, don't kid yourself. You can't continue to spend the way that the government's been spending. And I'm not saying it's good or bad, but we're going to see some acceleration of tax rates. We can look at it and look at the impact to you to make sure you're making better choices. The next example, well, this shows what she should have done. If she would have came to us in 20 and we would have saved her that $53,000, what she paid is just what the accountant split with the IRS. I'm being a little, it's actually true. I mean, if you didn't have to pay it, you know, most of the accountants that I deal with, you wonder if they're working for the IRS. We work for our clients, and we're not afraid for the IRS, but we're going to do what's legally right, and we're going to look at things that we can legally reduce your tax liability. And if we can put these dollars back in your business or your pocket, it's better served in your pocket, in my mind, than giving it to the federal government at this point. Here's the second example. This was a sole proprietor. We changed them to a corporate structure, and they came to us in 21 as well. And just by changing the structure or how they were not compensated, but how the company was set up from a sole proprietor disregarded entity, we were able to save them significant income tax to this individual. We saved them about $10,500 in 21. And their income is going to look like it's going to jump a little bit in 2022. So that savings is going to jump up, and it continues down the road. So again, we can put our clients through the software that allows them to actually see what that potential savings is. So you can make informed decisions on where you are today or compared to where you want to be, or it verifies what you're doing is correct. So it at least gives you some feedback. Not, you know, in most cases, most CPAs aren't running these types of scenarios to see if they're doing if there's anything else they could do to help reduce that tax liability. And again, what they lost last year, $10,593, gave it to the federal government, didn't have to. So again, what the software is looking at deductions, we're looking at legal entity design, we'll look at retirement, and the Tax Cut and Jobs Act, laying in all the new tax scenarios coming out of Washington, coronavirus, aid relief, all those things. It's running through these calculations to see what was missed, or if you took advantage of it, or if it was done incorrectly. We're not trying to point fingers at your current accounting people or tax people. We're just going to look at what's best for you based on what we're seeing from your tax returns and what your income is. The strategy of our tax planning goes through this. We do the planning up front, implementation, we do quarterly updates, and then the preparation of your tax return. The compliance is last. As you see, planning is first, figuring it out in the early year, what you should be doing, getting it implemented as soon as possible, looking at the financial statements on a quarterly basis to see where you're tracking, making those decisions. And again, our busiest time of year from a planning perspective is October. Right the beginning of the fourth quarter, we want to see what's going on and the impact of December 31. If you hit December 31, you've already missed it. 3 months out, you need to start doing your annual planning then. And then your tax returns, the preparation and compliance should match what the planning was when we put it into place. So we track this through the course of the year, and we do this with every one of our individuals and business clients. Here's what we charge, and we're very transparent. Anybody on this call today, we will do this analysis for $500. If we can't find $10,000 worth of savings, it's $500. It takes time for us to run this analysis, but we'll do it. But we're going to need some information to do it. If we find 10,000 or more in savings, and you want us to do the planning, it's $3,500. If we do the implementation, it's $5,500. If you want us to do all the implementation, do all your tax work, we do this on a recurring retainer basis. We charge from $2,750. If it's multiple entities, it'll change, but for one corporate entity, it's $2,750 per quarter. That involves all your tax returns, quarterly meetings, and we will do the analysis on an ongoing basis, preparing your individual and business tax returns, quarterly estimates, sales tax, all of that. That's what we charge for our services. And again, $500 to do a dive, it's well worth it. And I think if we find $10,000 worth it, we can show you the planning. It's something, if you want to use your existing client, we'll do the planning for them, and then you can hand it over to them. This is what we need. again, we're gonna do the tax planning versus preparation. We need the last year's P&L and balance sheet, or up to date if possible. We'd like to look at the last year. A current P&L and balance sheet. And we will look at, we need your last tax returns filed, both business and individual. We have a portal that we can upload, send you a link, so everything's secure, comes right into our tax practice, and then we'll do our analysis. If you're interested in engaging and looking at that, again, the cost is $500 just to do it. But if we find you 10,000 or more, which is extremely common, it's well worth your dive and time. It's not going to cost you, plus it's tax deductible. If you're interested in having an individual consult with me, Jordan will provide my contact information. I give you my cell number. I'm approachable, so you can call me on the evenings or even on the weekends. I take phone calls from all our clients. We are very approachable, and I really appreciate your time today. If you have questions, I know we went kind of fast, but again, this was an overview. One last note: we're going to be running a series of these informational webinars. We're going to run this one again. Then we're going to run Have You Outgrown Your C Corporation? And then another one we're running, which is interested for those individuals that are currently C corporations. We can show you strategies where we can take all your net profits that you have sitting in your corporation that hasn't been taxed yet. We can show you strategies that you can move unlimited amounts of previously taxed net or retained earnings inside your corporation. We can show you how you can access them with very little income tax. There's some very good sound strategies that most of the business owners that we work with take advantage of, including myself. You know, we utilize a lot of the same strategies that we promote, which is to help, again, our clients. And we'll be running these series. So if you want to invite friends, you'll see some more invites coming down the road here. Jordan? Okay.
Yeah, thanks, Jim. That's some really interesting stuff. Now, let me ask you this. Why do you think most accounting firms or CPAs or tax people don't provide this type of service? Are they too busy, or they just don't know about it, or what?
Again, I think on most of it, I grew up, my father was a CPA as well, and most of the CPAs, including my son who works in the practice, they come from very large firms. They're taught to start looking at tax planning at the end of the year. And normally what happens, the client will give them their W-2s, they'll give them their financial statements, and it's typically at the end of the year. And then the CPA, oh, by the way, you might be able to do an IRA deduction or a qualified plan deduction, and that's
Right.
the extent of it. They're really processors, and there are very few firms out there that focus on the tax planning side. We are a tax advisory firm, and we really promote tax planning up front. Compliance is extremely important. You want to do it correctly. You want to file your tax returns on time. You want to make sure they're calculated accurately. You're taking advantage of certain code sections. You want to make sure they're applied properly. But at the end of the day, the tax return should match your planning. If it's not matching the planning, you're not getting the benefit. And that was one of the reasons why we started HST. And that's why we do this tax work across the country. We've got clients, again, from California to Connecticut and all points in between. Yes, we're focused in Houston because that's where we are, but we do this nationally. So the reason is this is what they were taught. They're not taught to do the tax planning. They're taught the compliance. And if you want to do tax returns, you just don't know how to do the planning. Plus, because we utilize a very sophisticated piece of software that helps calculate this process. It's expensive, but it's out in the general public, but they don't take advantage of it. And I think that's the only way.
Yeah, it's almost like they've been taught to just get the numbers and do the work and be done with it, rather than being taught the proactive type of planning that you guys are doing, which I think is really exciting. And really, that's some great information, Jim. So yeah, I in the chat I put James's cell phone number. So feel free to text him or give him a call. He'd be happy to answer your questions for your situation and see if HST can improve your tax situation. Because, let's face it, nobody wants to pay more than they have to the government. I mean, I know it really is frustrating.
And we'll send everybody to attended a thank you email. So if you want to respond to that as well, it'll come from my email address and you'll see our contact info there.
Great. Well, thanks again, James, for coming on. And I'm glad we could put this on for all you folks out there. And like I said, feel free to call the office or call James directly and we can see what we can do for you and your business.
Thanks, guys.
Thanks, Jim. See you.